Now, it is important to point out that because this is an alternative investment, it is a non-traded REIT, that investors must meet certain qualifications to be able to invest in a real estate investment trust. And we don't know Bill's all of his specific or unique situations. We do know he's 70 years old,
right,
which gives us a little bit of a topic of discussion there.
So with some broker-dealers, LPL in our case, with some broker-dealers, there are limits to what percentage that you can invest based on your age. There are limits regardless of your age and regardless of a broker-dealer based on your liquid net worth, but some will apply additional limits on how much you can invest in a real estate investment trust based on your age. And the reason for that is, if you think about as you age, the probability of you needing access to money for medical needs increases as you age. And so we want to be sure that any investor does not have too much of their assets tied up in something that really should be considered inaccessible. And when I say should be, there are liquidation opportunities, unless it gets locked down by the company. There are liquidation opportunities along the way, but it is not as liquid as a stock, for example, or cash that you have at the bank, obviously. So that's why this is important, to really focus on your liquid net worth. So let's talk about what that means, even, Scott. Liquid net worth is not going to include the value of somebody's home, because if you have $10,000 in medical expenses, you're not going to sell a bedroom off of your house. You can't carve off a piece of it and liquidate that portion.
You can rent it.
So, yeah, you could rent it. So you want to think about what is liquid, and these percentages are related to your liquid net worth.
Yeah. So a couple of things on the broker-dealer side. Our broker-dealer here is LPL Financial, so it sets some limitations on how much of someone's liquid net worth can be invested into real estate investment trust, or really into an alternative investment of any kind. And those numbers, those percentages, depend on the investment objective of the account which holds the real estate. So in most cases, the investment objective is going to be growth with income for our clients. So let's just use that as an example. May not be yours, depending on where you do that and what you do. But if it's growth with income, your liquid net worth, if you are under $1 million, you can put 10% of your liquid net worth into the alternative investments, which could include real estate. That is also an Arkansas rule. So the state of Arkansas has also put that in place. LPL's is actually a little bit higher, but if you're in Arkansas, we'll consider that 10%. And then if you are $1 million or more of liquid net worth, you can actually put up to 20% of your liquid net worth into those programs. But in Bill's case, Bill is 70. So to Janet's point, as you get older, that cutoff is 70 for LPL. In that same investment objective of growth with income, it limits you under $1 million to 10% of liquid net worth. If you have over $1 million of liquid net worth, the limit is 12% in alternative investments, and then no more than 10% in any one program. So any one REIT, we'll call it.
So, Scott, we've gone kind of deep in some of these areas. I want to kind of just back up and give an overarching big picture answer to Bill's question. In general, we are fans of non-traded REITs. I will say they're not right for everybody. They're not right for every situation, and the percentages matter based on the details of your situation. But we like that it is, here's the key for me, that it is a non-correlated asset. What that means is when the stock market is doing its thing, up, down, sideways, whatever, it doesn't have any impact on what a non-traded REIT is going to do. It's not going to, when the stock market goes up, this goes down, or when the stock market goes up, this goes up. This is going to do its own thing. Going back to Amazon stock value versus Amazon paying rent, that stock value, sometimes it's up in a J-curve path, and sometimes it's down and it's ugly. But that rent check is there in January, February, March. It is just, that's what we're looking for. Now, the value of the building is still going to fluctuate. So you do have that fluctuation still, but we want to be sure that people understand the reason that we really like it is that it's not correlated to the stock market and it's not correlated to the bond market. So it is another way for us to diversify when it's the right fit.
Yeah, and we do need to move on, but I do want to throw in there real quick too, if it's non-qualified money, if it's non-retirement money, after-tax money that you're investing, there are some tax advantages, potential tax advantages to that distribution of those real estate investment trusts. So if you have some of that, it might be an attractive investment to take a look at. But again, and I would end this Q&A session with Bill to just say it needs to be part of your overall plan. It doesn't need to be just a random investment. Where does it fit in your overall plan? We consider it, from an investment perspective, kind of a bridge between the fixed income and the equities. So it is a diversifier. That's where it fits. And we'll kind of get into the overall planning really with our next question.